Ladies and gentlemen, in this corner at 5 foot 10 inches and 205 pounds of Coca-Cola and See's candies, the Oracle of Omaha, Warren Wildman Buffett. His opponent at 5 foot 6 inches and 120 pounds of fightin' Irish, Cathie Can't Stop Me Wood. It's the investing matchup nobody asked for, the Wu-Tang fighting styles of Buffett versus Wood. And okay, I know some of the shine has come off of Cathie Wood's investments, but be honest, you were praying to the lost ARK when it was up almost 250% in a year. I mean, just the ARK K was a $30 billion fund, and total AUM for ARK Invest was over $50 billion at its peak. So even if Cathie Wood is the Spice Girls of investing, the song you all deny ever liking, but you had the volume cranked up on Wannabe when it was hot. Tell me what you want, what you really, really want. But the matchup with Buffett's style goes beyond that. We're talking growth investing versus value. What are the differences in investing styles? Which is better? And what the future looks like for each. Stick around and I'll reveal my favorite stocks from each portfolio, the best of Buffett and the best growth for Wood. Best growth for Wood, best growth to that's going to get me in trouble. But let's get started with the core differences here. How these two legends think about investing, because let's face it, Warren and Cathie couldn't be more different if they tried. Warren Buffett is the king of value investing. He's like that uncle who buys used cars, but not just any used car, one that's been cared for by this sweet old lady and has lots of life left in it. He's looking for companies with solid fundamentals, a long history of profit, and a moat of safety around their business, that competitive edge that keeps the competition out. Cathie Wood, on the other hand, isn't buying used cars. No, Cathie is buying flying cars that maybe haven't even been built yet. She's all about that disruptive innovation, finding the companies that are going to change the world, ideally pretty soon. It's futuristic, it's daring, and sometimes it's kind of like betting on that friend who swears they're going to be the next Elon Musk. Put another way, Buffett is investing in mature companies leading their industries with dependable cash flow and stocks at a reasonable price. He doesn't want to be surprised. He's just fine with that 10 to 15% annual return if it means he doesn't have to worry about his investments. Wood, though, she doesn't mind surprises and recognizes that for those moonshot investments, you've got to take those risks, and some of them aren't going to work out. She's investing in new, innovative companies that could disrupt the way things are done in their industry to someday become the kind of stocks that Buffett buys, and of course make her insanely rich in the process. And again, more than talking about Cathie Wood or Warren Buffett here, that's what we're talking about in this video, about that growth versus value investing style, which produces higher returns, and which is going to be right for you. I'll show you the best and worst stocks from each investor next, but using either style means keeping up with the news, and for that, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign-up link below. Now let's look at their finest moments, the shining stock picks that made headlines. First up, Warren Buffett. This man made Coca-Cola more than just a drink. It runs in his veins, and it's one of his biggest wins. Buffett started buying shares of KO in 1988 and adding to it until 1994, investing a total of $1.3 billion for about 400 million shares. It's his fourth largest holding in the Berkshire Hathaway portfolio, at almost 9% of total assets, and a control of 9.3% of the Coca-Cola company. In 1994, Berkshire received a dividend of $75 million on its shares of Coca-Cola. That's not bad at around a 5.7% yield on that original $1.3 billion investment. It gets slightly better though. By 2023, that annual dividend had grown to $736 million. That is a 60% annual dividend on the original investment, on top of the stock value that is now worth $27.7 billion. I know you probably expected me to highlight Buffett's investment in Apple, starting just 8 years ago and netting him roughly $76 billion on a recent sale of half his stake. It's a hell of a lot more than he's made in Coke, but Warren has made so many great investments that it's hard to pick just one. For her part, Cathie Wood has been the queen of Tesla. While Wall Street analysts were shaking their heads, Cathie was backing up her electric car to load up on shares of TSLA, buying $1.3 billion worth in the fourth quarter of 2016, a split-adjusted price of just $13 a share. Those shares were worth as much as $410 just 5 years later in 2021 for a 3,150% return. That is doubling your money every year for 5 years. Think about that. Even on Buffett's spectacular 19.8% annualized return on shares of Berkshire Hathaway since 1965, it would take you 19 years to get that 3,000+% return. From Coinbase to Roku and Block, Wood proved that it wasn't just the right place at the right time with some spectacular returns. And before we get to their worst stock picks, it's your turn. Which would you be buying right now? Coca-Cola or Tesla? Apple or Coinbase? Let me know in the comments which do you think are going to produce the higher returns, and I get the feeling this is going to be a good argument. But of course, it wouldn't be a fair match without highlighting a few of the oopsie moments for each, the stocks that aged like milk left out in the sun. For Buffett, it doesn't get much worse than his $2 billion loss on shares of IBM, buying $10.7 billion worth in 2011 at $170 each. To do so, Buffett broke his no-tech company rule because he was impressed by how well IBM kept its customers. Now, Big Blue might have been keeping customers, but it was losing its competitive edge and market share to others like Microsoft and Oracle. The stock went nowhere but down, and Buffett finally dumped it early 2018, around $140 each. Even bigger may be his paper loss on shares of Kraft Heinz, holding on to 325 million shares worth $11.2 billion. The Oracle partnered with 3G Capital to buy Heinz for $23 billion and then engineered the merger with Kraft in 2015 that saw the new company trading at $71 a share. He still owns 27% of the company, with the stock trading at just half that amount. And Cathie Wood may be known for her rocket-like returns, but those rockets have failed to launch over the past 3 years. From Teladoc to Zoom, nearly every pandemic stock has been wiped out, and Morningstar crowned Wood the #1 wealth destroyer this year, wiping out $14.3 billion in investor assets. I'll explain why their strategies have worked and sometimes have not worked out, but to be fair, I do like many of the stocks Wood and her ARK Invest holds, which I'm going to get to later on as well. One of the biggest problems for her funds, though, for me, is not the stocks she picks, but her tendency to trade them. Several times, I've seen one of the funds dump an investment, only to see the stock jump a few days or weeks afterwards. Wood sold 1.96 million shares of Virgin Galactic in May of 2021, around a split-adjusted $330 each. Had she waited just 1 month more, she would have gotten more than 3 times that, as the shares topped $1,100 each. And that happens more often than it should. Supposedly long-term growth stocks sold on those short-term losses, only to see that growth theme plays out later. Now here, it's not hard to see why Buffett's value strategy works. They may not set the world on fire, but leaders like Coca-Cola, Chevron, and Apple are cash flow machines. It's that long-term compounding of returns that is every investor's friend. Buffett's buy and hold strategy may not work as well as tech or growth stocks during a bull market. In fact, you can see here that the shares have underperformed the QQQ ETF of tech stocks by 75% just over these last 10 years. But the ups and downs aren't as violent either. In bear markets, when tech stocks crash, those bellwether consumer staples, financials, and energy stocks just aren't going to fall as much. Here, Buffett is buying quality companies with a competitive advantage, but only when the stock price is a good deal. And with more than 60 years running in his investments, Buffett is willing to take the time to wait for those good deals. That means whether the market rises or falls this year or next, Buffett always knows that over time, his stocks are going to produce those solid returns. Now, I said earlier that Cathie Wood's success was more than just the right place at the right time, and I think we see that here in her fund's performance just after the pandemic, beating the tech-focused NASDAQ by more than 200% to its 2021 peak. But then clearly something went wrong. Tech and growth stocks have continued to do well over the last 3 years, but the ARK fund has gone nowhere. So clearly some of that was right theme, right time. Growth and tech stocks will always do better in a bull market and when interest rates are low. It's the fast revenue growth that drives these stocks, so broader economic growth is going to act as a tailwind to that. Also, I don't want to get all economics nerd on you, but because of how stocks are valued with a discounted cash flow model, then lower interest rates means those future cash flows that are so important to growth stocks carry a much higher value in today's dollars. With rates near zero after the pandemic, it was like printing money for a lot of these growth stocks. Now, Buffett's long-term returns have proven out over decades, but which strategy here, growth versus value, wins out going forward depends on what you think the future looks like. That tech-heavy NASDAQ QQQ has beaten Buffett's Berkshire Hathaway going back 20 years as tech just really took off after the bubble. But if we go back further, 30 years, and include the massive dot-com crash, then it's the value stocks that have produced those higher returns, with Berkshire up over 3,000% and easily beating the 2,300% return on tech. While we may indeed be in a bubble for AI stocks and other tech, and the market is clearly expensive right now, I do think artificial intelligence will unlock productivity gains like never before seen. That could drive an economic growth and earnings into a decade-long bull market, and I think tech and growth is where you want to be. While Cathie Wood is taking her lumps now, she's positioned for those biggest revolutionary shifts in AI, robotics, and genomics. If she can just hold on to those stocks and let the future bring those returns, she could ultimately win out. Of course, Buffett style will never let you down, so if you want less risk and are comfortable with potentially lower returns, then it's hard to go wrong with this quality company value stocks. I'm going to reveal my favorite stocks from both Buffett and Wood's current portfolios, but knowing which to buy means knowing how to analyze stocks. Nation, I dig into the research on all the stocks we talk about here on the channel, but you can't depend on some YouTuber to pick your stocks for you. Nobody cares about your money like you do, and you need to take control, so make sure you check out this video next, a complete step-by-step to analyzing stocks to buy that will make you a better investor. Looking at the current portfolios and my favorite stocks in each, CNBC runs a nice Buffett tracker to see his Berkshire stock investments, including recent changes. Here you can see the total value of shares held, how big the investment is as a percentage of his portfolio, and the ownership stake that gives him in the company. Both of those are important clues to his confidence in that investment. How much of his money is he willing to put into one stock? And what kind of controlling share does that give him? As for some of my favorites, it's hard to go wrong with many of these. Most of these lead their industry in market share or have a strong competitive advantage that means cash flow growth for years. One of my favorites here, Chevron, ticker CVX, has long been a favorite oil stock of mine. Shares haven't done much over the last couple of years, but I believe there's a lot of value here, and you're getting a 4.3% dividend while you wait. I'm also looking at Ally Financial, ticker ALLY, after a big drop on its recent earnings. Now, all you out there in the nation know I prefer SoFi Technologies for my fintech pick, but Ally is trading at a very low valuation of just 0.93 times book value right now. Finding all Cathie Wood's current investments is a little more difficult because they're spread throughout 8 ETFs, though I think you can say that her most confident picks are going to be in this ARK Innovation Fund, the flagship ARKK ETF. If you click through and go to holdings here, you're going to see the top 10 stocks along with the total value and weight in the fund. But you can see all the stocks by clicking to download the PDF or Excel file. And again, I think that theme of disruptive technology through artificial intelligence and robotics is going to play out over the next decade. So you're going to find some of my favorite stocks right here. Stocks like Palantir, which is up 39% in just the 3 months since recommending it on the channel. Or Shopify, where I'm up 36%. Both of those with a combined profit over $30,000 so far in my own portfolio. And again, all you out there in the nation know SoFi Technologies is one of my favorite growth stocks, up 34% and more than $50,000 since I started buying 2 years ago. Stay on top of the news and market trends with the Weekly Bowtie, our weekly newsletter with all the stocks to watch and news you need, free with the invite link in the description. Or click on the video to the right for the complete stock analysis video. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.